So this presentation is definitely going to be pretty intense. I'm going to be throwing a lot of information at you folks. I think most of the people in this room will be able to handle it because you've been around this for quite some time now, I'm sure. But I've tried to simplify it and condense all this information as best as possible. But again, it's going to be a lot, so just try and focus and pay attention as best as you can because it is to your own benefit. I'm going to start off with a quote, okay? And it goes like this: who controls the food supply controls the people. Who controls the energy can control whole continents. Who controls the money controls the world. This was said by globalist Henry Kissinger. And I just want you to keep that quote in the back of your mind as I go through the presentation tonight because it's pretty relevant to what I'll be talking about. If we're going to be successful in our fight to restore our republic, it's vital that we all have a fundamental understanding of money, banking, and debt. It's rather odd that throughout our lives, we're never really taught about much of this at all. But money is pretty important to all of us. John Adams once said, "All the perplexities, confusions, and distress in America arise not from defects in their Constitution or Confederation, not from a want of honor or virtue, so much as from downright ignorance of the nature of coin, credit, and circulation." And I really couldn't agree with him more on that one. So therefore, it's my objective tonight to provide you all with at least a basic understanding of what money is, how the monetary system and money as a whole has changed and evolved over the course of the 20th century into what it is today, and finally, why the current monetary structure is breaking down and what the possible consequences are. So let's start with the basics. What is money? Well, money is not wealth. It is the means by which wealth is exchanged amongst those who produce it. It's a medium of exchange that allows one specialist to exchange a product for the goods or services of another. And this allows him to avoid the inconveniences and inefficiencies of bartering. At its core, money is the most marketable commodity. So now, what makes a commodity the most marketable? Well, obviously it needs to be highly demanded, easily divisible, durable, easily transportable, and relatively scarce. Therefore, money, or what becomes used as money, is then determined by the market. Now, historically, gold has been the most marketable commodity. It happened over thousands of years, and virtually everyone in the world came to the same conclusion. Gold had the highest demand and the greatest liquidity of all the competitors. And it emerged on its own accord as a result of the free choice of individuals. Peter Bernstein said it best: nobody invented it, no grand plan was ever devised, no one ever wrote a rule book on the necessary codes of behavior. But that doesn't mean that other things can't be money. Seashells were once used as money, as well as tobacco, even salt. It's actually where the word salary is derived from. But the key to understanding money is that it's a commodity. It's not some abstract concept. It's not something only used for exchange, and its price and its value is actually determined by its supply and demand. And this leads to different kinds of money. We have what I've referred to thus far as commodity money, or hard money, but then there is also fiat money, political money. It is money by government decree, meaning it has been forced upon us, not because it has been chosen by the marketplace. And this leads to the most important characteristic of fiat money, which is that there is an unlimited supply of it. Because it is backed by nothing, you can theoretically print up as much of it as you like. And because our money is fiat money, it's this quality that creates the messes that we're currently dealing with. And this wasn't always the case. For the majority of our nation's history, our money was hard money, not fiat money. If we examine the types of currency used in America during the 20th century and into present day, we can get a good picture of how our money has lost its quality. Okay? So here we have a U.S. Treasury gold certificate dated in 1928 that states it was redeemable for $10 in gold coin payable to the bearer on demand. Now, this form of fiduciary money was as reliable as any currency in history. And when I say fiduciary money, I'm talking about honest paper currency, which is actually a receipt for commodity money. Here we have the first of the Federal Reserve notes, which were issued immediately after the Fed's creation in 1913. Because they circulated side by side with U.S. Treasury notes for 20 years, they too were redeemable in gold, as evidenced by the phrase redeemable gold seen here on a 1928 Federal Reserve note. Now, the American people were persuaded that paper certificates from the Federal Reserve were as good as a U.S. Treasury-backed gold certificate. And of course they were, but it was only for a period of time. It was in 1933 that the Roosevelt administration outlawed the possession of gold and ceased redeeming Treasury notes for gold. The American people were ordered to return in their gold currency, and most did, expecting that when the Depression ended, they would get their gold back, and of course they didn't. After 1933, the Federal Reserve notes declared that they were redeemable in lawful money, as stated on a 1934 Federal Reserve note seen here. But no one could exchange any of these Federal Reserve notes for gold because lawful money was no longer gold, though silver could still be obtained. Now here we have a U.S. Treasury silver certificate dated in 1934, which carried the promise to supply silver to the bearer on demand. But the solemn promise backing this honest fiduciary money was canceled in 1968, and U.S. Treasury silver certificates were no longer issued beyond 1968. So when silver backing for the currency was abolished in 1968, Federal Reserve notes became the only paper currency used in America. All such currency now states merely that this note is legal tender for all debts public and private. So basically it just represents debt. So over the course of some people's lives in this room, our country has gone from having the finest money system the world has ever known to irredeemable fiat money, a debt-based currency backed by nothing more but the full faith and credit of the U.S. government. And if anyone has seen the government's finances lately, we know that it's pretty ugly. Now, probably quite a few of you are asking yourselves, didn't Nixon take us off gold in 1971? And yes, you would be right to an extent. For many years, foreigners were entitled to exchange their dollars for gold, even though we as citizens were not allowed that right. But in order to understand the gold window and why Nixon abandoned this policy in 1971, it's important to have a good understanding of how the world monetary system had evolved into what it was in 1971 and why foreign nations could exchange their dollars with our treasury for gold. So let's go back a ways. The period between roughly 1815 to 1914 is known as the classical gold standard. With the exception of a few minor blips, such as Lincoln using greenbacks during the Civil War, which was a fiat money, as well as a controversial issue of silver, the world was on a gold standard. This meant that each national currency, whether it be the dollar, the pound, the franc, etc., was merely a name for a certain definite weight of gold. So the dollar, for example, was defined as 1/20th of an ounce of gold. The pound sterling was defined as 1/4 of an ounce of gold, and so on. So this meant that the exchange rates between the various national currencies were fixed, not because they were controlled by government, but rather in the same way that 1 pound of weight is defined as being equal to 16 ounces. Having this system in place enabled the civilized world to prosper tremendously. Using one money facilitated the freedom of trade, investment, and travel throughout the Western world. And it also allowed for job specialization and the international division of labor. This is the concept of comparative advantage, which any Econ 101 student is familiar with. But basically it's the idea that nations will produce and specialize in the areas that they're best in. Okay, so it allows for the greatest amount of goods to be produced and ultimately benefits all of us. Now, another great aspect about the International Gold Standard is that it kept the inflationary potential of government in check. And as you'll see later on, when governments can print at will, they will. And it's very inflationary. Now, what was also a key aspect of the system was that it provided an automatic mechanism for keeping the balance of payments of each country in equilibrium. What I mean by that is that it made countries leery of running trade deficits, because if they began to inflate too much and run deficits with trading partners, they ran the risk of losing their gold reserves. So for example, if the U.S. had accumulated a bunch of French francs by exporting more to France than they were importing from France, the U.S. could turn around and exchange their francs for gold with the French. Okay? Because nations didn't want to lose their gold, it forced them to export just as much as they import. Now, the classical gold standard of the 19th century was literally by far the best monetary order the world had ever known. Former Fed Chairman Alan Greenspan elaborated, and I quote, "Prior to World War I, the banking system in the United States and in most of the world was based on gold. And even though governments intervened in occasionally, banking was more free than controlled. Periodically, as a result of overly rapid credit expansion, banks became loaned up to the limit of their gold reserves. Interest rates rose sharply, new credit was cut off, and the economy went into a sharp but short-lived recession. Compared with the depressions of 1920 and 1932, the pre-World War I business declines were mild indeed. It was limited gold reserves that stopped the unbalanced expansions of business activity before they could develop into the post-World War I type of disaster. The readjustment periods were short, and the economies quickly reestablished a sound basis to resume expansion. Now, it's important to understand that the classical gold standard was not without its flaws, but really these flaws were because of government interference, such as the monopolizing of the mint, legal tender laws, the creation of paper money, and the development of inflationary banking. But even so, the monetary order under the gold standard worked, and it enabled the development of free international trade, exchange, and investment, and perhaps most importantly, it kept the business cycles in check. So if the classical gold standard worked so well, then why did it break down? Well, it wasn't gold that failed. It was the folly of trusting government to keep its promises. Governments were entrusted with the task of keeping their monetary promises, of seeing to it that pounds, dollars, francs were redeemable in gold as they pledged. However, in order to wage the catastrophic war of World War I, each government had to inflate its own money supply, its own supply of paper and bank currency. And this led to such severe inflation of the paper money that it was impossible for the warring governments to keep their pledges. And so they went off the gold standard, which really meant they declared their own bankruptcy. The exception was the United States, which entered the war late and did not inflate the supply of dollars enough to endanger redeemability. But apart from the U.S., the world suffered from what some economists now hail as the nirvana of freely fluctuating exchange rates, competitive devaluations, warring currency blocks, exchange controls, tariffs and quotas, and the breakdown of international trade and investment. Luckily, very few economists back at this time hailed this monetary situation. It was generally recognized this period was the threshold to international disaster, and politicians and economists looked around for a way to restore the stability and freedom of the classical gold standard. So how were they going to return to the golden age? Well, the simple thing to do would have been to recognize the facts of reality. The fact of inflated pounds, francs, marks, etc., and return to a gold standard at a redefined rate, a rate that would recognize the existing supply of money and price levels. The British pound, for example, had been traditionally defined at a weight equal to $4.86. But by the end of World War I, the inflation in Britain had brought the pound down to approximately $3.50 on the free foreign exchange market. The sensible policy would have been for Britain to return to gold at approximately $3.50, and for the other inflated currencies to do the same. Instead, they made the poor decision to return to gold at the old par of $4.86. And they really did this for a reason of British national prestige and in a vain attempt to reestablish London as the hard money financial center of the world. And in order to succeed at this, Britain would have to deflate its money supply and price levels severely. However, this was politically out of the question. Because of the growth of trade unions as well as a system of unemployment insurance, it made wage rates very rigid downward. We should all be familiar with this. So in order to deflate, the British government would have to reverse the growth of its welfare state, and this just didn't happen. So in fact, what actually happened was that the British continued to deflate its money and prices, and this really led the British to suffer during the 1920s, having depressed exports and rather severe unemployment rates. And all the while, the rest of the world was experiencing an economic boom. So how could the British have their cake and eat it at the same time? Well, at the Genoa Conference in 1922, Britain led the way in creating a new international monetary order, the gold exchange standard, which is where Britain basically coerced other governments into inflating or into going back to gold at overvalued pars for their own currencies, thus crippling their own exports and subsidizing imports from Britain. So here's how it basically worked. The United States remained on the classical gold standard, redeeming dollars in gold. Britain and the other countries of the West, however, returned to a pseudo-gold standard. British pounds and other currencies were not payable in gold coins, but only in large-sized bars suitable only for international transaction. This allowed for a wider degree of paper money inflation because people no longer redeemed their paper money for gold. And furthermore, Britain redeemed pounds not merely in gold, but also in dollars, while the other countries redeemed their currencies not in gold, but in pounds. So basically the result was a pyramiding of the United States of gold, British pounds on dollars, and other European currencies on pounds. And bottom line is the system just didn't work, and here's why. When Britain inflated and experienced a deficit in its balance of payments, other countries did not redeem their pounds for gold. Instead, they kept the pounds and inflated on top of them